So, want to welcome you all to yes another morning live technical class. Today is on Monday, the 13th of July 2026. I'm your host Benji FX. I want to welcome you all to this live analysis. So today we're going to be doing a technical class. We are beginning our session, and today I want us to discuss on a very good concept which is called liquidity. Okay. And liquidity is actually what drives the markets. And this is one of the smart money concepts that you guys need to understand, because once you understand liquidity, you're going to be able to understand lots and lots of things, all right, in the market. So we want to begin this session. So we're going to be discussing what is liquidity. Okay, why is liquidity very important to understand? Where does liquidity form? Types of liquidities that we usually have: liquidity sweep, liquidity grab, breakouts, external range liquidity, internal range liquidity, and also how to trade using liquidity on a bullish setup, on a bearish setup, and also some few common mistakes people do on liquidity, and also a bit of a liquidity checklist, and also my key takeaways and what I'll be able to conclude. So I'll only take 30 minutes of your time, and I want us to understand. So I'll be very quick, but if you guys have any question, please feel free to ask me on the comment section, and I'll be here to answer you. So we're going to begin with liquidity. So what is liquidity, and how can we be able to understand liquidity in a way that is actually simple? So I usually explain liquidity in this manner. So liquidity, it's like a car, moving car, right? Or a vehicle, a matatu or a manyanga. And this matatu is not full, and it's moving from point A to point B, probably from home to town, okay? And if this matatu is not full, and probably passengers are behind, and a tout or someone who sees, or even the driver sees people behind, and the matatu is not full, what the matatu is going to do is going to drive back, collect those passengers, then move to the desired or the destination. So that's how liquidity usually define it in layman's language. It's just like a car that is driving, but it's not full yet. Okay, so it wants to be able to do what? It wants to be able to have enough people in the car so that it can be able to make maximum amount of money. So liquidity is just like a driving matatu. So it's the same concept. So in explanation, liquidity is the collection of pending buy and also selling orders resting at a particular price level in the market. And this is where institutions and also smart money look to fill large positions, right? So liquidity, in simple terms, is where stop losses and pending orders are usually concentrated. So liquidity, in simple terms, is where money is resting. Okay, there are usually situations or areas where money is usually resting, and the market has to come and collect this money before the market moves to the intended direction. So I want you guys to understand that the fact that liquidity has to be consumed fast before the market moves to the intended direction. So the market, once market takes liquidity from one side, the market will move to the opposite side. Okay, so smart money don't chase the price. All right, what they usually do, the price moves toward liquidity before executing the real move. So this is where you guys are probably taken out and you don't understand why. So liquidity is very, very important. Okay, now liquidity will help you as a trader to understand these different things. Number one, it will assist you in identifying high probability reversal zones. All right, it will assist you in identifying high probability reversal zones. Okay, I'll be able to explain more on this. It will also assist you in avoiding. Okay, so you're going to be able to avoid false breakouts. Okay, false breakouts. All right, it will be able to assist you understanding what we usually call institutional order flow. So IOF is what we usually call institutional order flow, and also it will improve in your trade timing. very important. So once you understand these key things or key things that you're supposed to do in the markets, then you are good to go. So once you understand that once you understand that liquidity is going to assist you in trade timing, especially how to time your trades, okay, so that you don't get caught by probably entering early, then that's going to be very, very important. Another thing is institutional order flow, avoiding false breakouts, and also will assist you in high probability reversal zones. So where liquidity or where does liquidity form? So liquidity usually formed in different areas. So usually form in equal highs, equal lows. So these are examples where liquidity usually forms. Very important. So liquidity is formed on equal highs, okay, equal lows, all right. Then we usually have previous day high, previous day low, stroke previous day low. Okay, so these are areas where liquidity is usually formed and market has to consume all these. Where else we have the previous week high, stroke the previous week low. Then we usually have Asian highs and Asian lows, or London session high or lows. So we can be able to call them session highs, and lows. Okay, London highs, London lows, Asian high, Asian low, New York session high, session lows. So those are also liquidity areas. Other areas where we have is swing high. You can have a swing high or even a low. Okay, then we can be able to have trend line liquidity, LQD. We can also have a consolidating market. Okay, consolidation ranges. That's where most of liquidity is usually found. So these are the areas where we usually find a lot of liquidity resting. So it's important to understand all this. Okay, from here, once you understand that this is where money is resting and money has to be collected before the market pushes either higher or lower, then it's important for us to understand that once liquidity has been consumed from these areas, then the market can be able to move. Okay, so we go to the next thing, which is what we usually term as types of liquidities. Okay, types of liquidity. Okay, it's a very important concept. Once you understand this concept, then you're good to go. Okay, so just a minute. Here we go. So types of liquidity usually have, they're different. So the first one we're going to start with is buy side liquidity. So that's the first one. We're going to discuss more on number one, buy side liquidity. Buy side liquidity. That's how we usually write it. Number two, we're going to talk about sell side liquidity. So these are ICT concepts, which is very important. We're also going to talk about, from that, we're going to be able to talk about external ERL, external range liquidity, and also we're going to talk about, okay, internal range liquidity. Very important. What else are we going to be able to talk about? Buy side, sell side, external, internal. Okay, so let's just talk about this in 10 minutes so that we can be able to understand all this. Okay, so these are just types of liquidities, and I'll be able to give you some explanation on the same. Then from there, we're going to talk about liquidity grab, breakout, external, and also liquidity sweep, the differences between those two, because I usually find that these are the things that people usually don't understand mostly. So let's talk about types of liquidity. We're going to start with the first one, which is the buy side liquidity. So what is buy side liquidity? Buy side liquidity, LQD. Okay, so what is buy side liquidity? So buy side liquidity is liquidity that is usually found above highs. Okay, so examples on buy side liquidities. So this is liquidity formed, LQD, formed above highs. Okay, formed above what? Formed above highs. And where can we be able to find this liquidity formed above highs? We have the equal highs, previous highs, swing highs, trendline resistance. So institutionals often push prices above these levels to trigger buy stops before even reversing. So buy side liquidity, if I can be able to actually draw it for you, okay? Let me just use the highlighter. All right, so most of the time you're going to find that we usually have, probably this is our graph that is actually here. Okay, and probably market is pricing that way, so market probably can create equal highs that way. All right, so this that is actually formed above this area. Okay, this is what usually term as buy side liquidity formed above high. So this is buy side liquidity. Okay, so probably it can be equal highs, it can be session highs, it can be swing highs. All right, it can also be able to be trend line resistance. Okay, so all those things. Okay, so this is just liquidity that is formed above, so it's usually called buy side liquidity because it's offering markets to buy, take out that liquidity, and probably push lower. Okay, so that's what usually call buy side liquidity. Very important to understand. Okay, I hope you're good with the buy side liquidity. We talk about the sell side, then we're going to be done with the buy side and also the sell side. So let's come here. We do so that's the buy side. Let me just have this over so that you guys can be able to just have a look at it. Then you can be able to discuss also about sell side liquidity so that you guys can understand the difference. So sell side liquidity, sell side LQD. Okay, so this is liquidity that is formed. Definitely, you guessed it right. So this is liquidity formed below lows. Okay, below lows. So a good example can be able also to have a good drawing so that you guys can also be able to understand. Okay, so the market probably was selling. Okay, so it creates equal lows like this one. So this is what usually term as sell side liquidity. Okay, probably equal lows, previous lows, swing lows, and also trend line support. Okay, smart money often sweeps these lows before buying. Okay, so the market will always come, take this low, then we'll start buying. On the buy side liquidity, the market will take these highs before the market starts doing what? Start selling. So it's more like a liquidity grab. So the market has to grab that liquidity before the market does the opposite. So on the buy side liquidity, institutions often push prices above these levels to trigger buy stops before now reversing. And also on the sell side, the market always takes or sweeps these lows on the sell side liquidity. Okay, sweeps these lows before now we start buying. Now, when you apply this concept of liquidity with supply and demand, for example, if you're having a supply zone, okay, we're having a supply zone around this level, probably it's a higher time frame supply. All right, then below it we are having equal highs. If the market is going to take out this, okay, tap into our supply, we can be able to sell this market. So buy side liquidity is offering buying opportunities to take out this buy side liquidity, tap into the supply, then we can be able to sell. On the other hand, sell side liquidity offers the markets to sell. Then if the market is able to come and also have our demand level, a higher time frame demand level, after now sell side has been taken, market taps into our demand level, then we can be able to buy this market after the demand has been mitigated, sell side liquidity has been consumed, the market can move to the opposing liquidity. Okay, please give me the reactions if you are getting what I'm talking about on liquidity. It's actually good, very important. Thank you so much. All right, that's amazing. So that's the difference between buy side and sell side. So what we usually do, we combine liquidity with supply and demand to get what we usually call high probability setups. That's the simple thing that we usually do. So buy side liquidity that is actually resting above highs. Sell side liquidity that is actually resting below equal lows or even lows. Okay, so That's the difference between these two, buy side and also sell side liquidity. And I'll be able to also to use more of examples, especially on gold and also on GBP/USD, so that you can be able to understand more on the same. So that's buy side liquidity and also sell side. So I will just be able to delete all this. Then we can talk about the next thing, which is now external range liquidity and also internal range liquidity. So I believe you're doing well. So let's come and talk about external and internal range liquidity. Okay, the difference between internal and external. So from the very same term, external and internal. External is found from the exterior, internal the interior. So external stroke internal range liquidity. Okay, so they're usually termed as ERL and also IRL. Okay, so we'll start with the internal. So I want to have an example of a chart. Okay, that is actually here. Then we can have a bullish market. Okay, a market that is actually buying, and you can have our starting point from this level. Okay, so the market gives us this kind of a structure, pushes higher. Okay, comes back, creates this, comes lower, creates this, goes higher, okay, creates that, goes lower, all right, then pushes higher. So we can have this kind of an example for a start. Okay, now we usually have external and internal liquidity. Okay, and I'll be able to point out those areas where we usually have the internal and where we usually have the external. So remember, this is a graph of price. So the price is usually on the y-axis. Okay, it's usually found on this right side. It's usually not in the left, but no problem. It's the same area. Then this on the x-axis is the time. Okay, so this is what we usually have as the time and price graph. So this is a graph. It can be Euro USD, gold, GBP USD, whatever you want to call it. Okay, either way. Let me just have this to draw it quite well. Let me have this, just a minute. Let me just draw it using simple structures like this. The market pushes higher, creates equal highs, pushes lower, okay, goes all the way down. Okay, have this, pushes higher, okay, pushes lower again. So we can have that. And let me make sure that I have it as ×2. So this is just a bullish structure. Okay. And this is how the market will always look like. So I'm just explaining the difference between the external and internal range liquidity. Okay. So I will start with the first one, external. So external range liquidity is liquidity that is actually resting outside the current trading range. Okay, outside. So where we usually have it from the outside, definitely it's from these levels. Okay, you can be able to see from these levels from the outside, the exterior area. All right, so it can be all lows or all highs. So this is where we're having our external range liquidity. Then for the internal range liquidity, I'll just make sure that I change the color. Then this is where we can get the internal range liquidity. Okay, mostly usually find them in the internal. Okay, how to be able to understand external and internal is quite simple. Just mark out break of structures. So whatever is found inside, that's internal. Another break of structure, whatever is found inside, that's internal. Mark the break of structure. Whatever is found inside the break of structure, that's what we usually have as internal. So the internal structures are found inside a particular swing high or swing low, and internal structures are found within that area. So liquidity, external range liquidity is liquidity that is actually resting outside the current trading range. So we can have previous day high, previous day low, weekly high, weekly low, monthly high, monthly low, and this often acts as major targets for price. Okay, so most of the time, how the markets usually form, the market will always move from internal liquidity to external, or from external liquidity to internal liquidity. Okay, I want you guys to understand that. So let me just make sure that I don't have any drawings so that I can be able to explain it to you quite better. So this is just an example of a chart that I am having. So before I continue, let me talk about also with internal. So internal liquidity is liquidity that is found inside the current trading range. So examples we can have is equal highs, equal lows, minor swing highs, minor swing lows. We can have even internal trend line liquidity. So these are often targeted price before market moves to external range liquidity. So for example, make sure once you understand liquidity and you also apply liquidity with also supply and demand, then definitely you can be able to make some good amount of money. So come here, just come with me. So this is our first break of structure. All right, that's where the market actually broke structure. Then we have our second break of structure from this level. Okay, so I want you guys to understand break of structures, which we have is externals. So I'm marking the external break of structures which are there. Okay, so the first break of structure, that is going to be this first one is going to be our clear demand level. Okay, this is going to be our clear demand area, and this is going to be our deepest demand level. Okay, so this is going to be our demand area where we can be able to hold this market all the way to this external. So this is the external. Okay, so this is our first external ERL. So let me just mark it out as ERL. Usually ERL before the market takes out also. This is also our external range liquidity. External. Where do we have as external? Here we have it. Okay, and then we have this high. It's going to be our last external range liquidity, and whatever that is found inside is internal. So we have this as our internal. We can be able to mark them out. So this is internal range liquidity. This looks like equal lows. Okay, same thing here we have as an internal range liquidity, right? Same thing case scenario that is actually here. Now I want you guys to understand that this is a break of structure, quite good. This is a minor or an internal change of character. Okay, remember the external structure is bullish, internal we can be bearish, and this is where things get confusing for actually beginners, and they are actually confused. Are we bullish or are we bearish? So at this particular area, this is where we can have a minor change of character, or we can even call it a change in set of delivery. I love to call it a market structure shift, but this is a minor one on lower time frame. And this area, after now liquidity has been consumed, we can have an internal break of structure. Here we can also have been able to have a break of internal structure, and because this was the high that was left out, now we can have an internal market structure shift. Now this is where the market shifted its structure. Okay, an internal market structure shift. All right, then definitely this is going to be a big break of structure. This also is going to be a break of structure, but this here is where we have an internal market structure shift. All right, a break of structure, but this is a bearish break of structure. Same thing case scenario, a break of structure. And from this market structure shift, what we usually do, we mark out our level of demand once again. And this, as I said, it will assist us on institutional order flowing. This was our last area before the market did what? Pushed higher. And this is going to be our demand. Because this market is bullish, we'll be focusing on looking on buying opportunity. So the first level that we were supposed to look for buys is this level. Target is going to be in this high. That's going to be our target. So first target has been consumed. The next level that you're supposed to look for buy is this level. Okay, exit definitely at this high. So full TP is realized. All right, from that level. So first TP, second TP. So that's how we are able to realize or probably get into trades. Supply and demand and using concepts of liquidity. I see we have a good question. What about below the demand, the swing low? Is there also an ERL? Now, depending on also depending on also how the market actually had the institutional order flow from the left side. So it's quite important to understand that order flow, how where you mark it actually matters a lot. So what we want to do is this level of demand, we want to mark it with also a higher time frame point of interest or a higher time frame demand level. If the market was able to react from this area, we come to lower time frame, especially M15 or M5, to check on this kind of order flowing. Remember, this is a bullish structure, but as always, we can be able to get sells from this level, and this is where now my concept of pullback, we can be able to have it, okay? So we can have some sells from there. Once you understand liquidity, then things can be amazing. So we can have some sells from this level. We can also have sells from this structure, from this level. All right? So as much as yes, this market is actually quite bullish, we can be able also to find some good selling opportunities, especially from the premium side. Remember, discount and premium, we buy when the market is on the discount and we sell from the market where it's on the premium side. So those are the levels and areas where we can be able to have pullback entries. So the continuational entries are entries where we get buys in a bullish structure, reversals, pullbacks, or what we call corrective moves, we look for sells in a bullish market, which actually is not quite ideal, but we can be able to have some good sells from a bullish structure. But these are pullback entries. So because I was explaining the external and internal, I don't want to go into deep. Now this is what I've gone into deep into institutional order flowing, but it's not really a problem. But I hope all beginners can be able to understand, and also intraday traders, and also swingers, and also intermediate and also advanced traders. So this is the external structure. All right, this is external structures, and whatever we have inside the structures or this range, because this is our range. This is our start. This is the start of our range. This is the end. Whatever we get inside, that's internal liquidity. Okay. Whatever you find now, this is going to be our range from this low to this high. Whatever is inside, that's what we usually call internal liquidity. I will have a session where I'll be able to talk about institutional order flowing and also advanced market structure, how to be able also to get the pullback moves, the continuational moves, and have what we usually call a sell to buy kind of a model, which is very important. Okay, so that's what we are having on internal and external. Please react if you are following and if you're understanding these concepts, which this is just the beginning. Okay, this is just the beginning of liquidity. We're going to go into advanced concepts on also how to be able to get engineered liquidity entries, which is very important. Okay, so let me just delete this for now. Okay, but I hope you guys are following through quite well, quite good. Yeah, so let's remove this and also this. All right, so that's internal and external structure. So how to trade using liquidity, using a bullish kind of a setup. Okay, so these are just some key things that you need to understand. Okay, now we are looking on how to trade liquidity using a bullish setup, just like the one that I've actually shared. Okay, now this is a bullish setup. So the first thing that we usually do, number one, is we identify higher time frame bias. Okay, are we bullish or bearish? Definitely, if you're bullish, that's good because we're looking for a bullish setup. Number two, higher time frame bias. Sorry for this. Identify higher time frame bias. Number two, mark. Now here, for a bullish market, are you going to mark sell side liquidity or buy side liquidity? For the people who have been very observant. So we are looking for buys in a bullish market. After you've marked higher time frame bias and you know now the market is bullish, bias is just knowing what is the trend? Are we bullish or bearish? So are you going to mark your sell side liquidity or buy side liquidity? Quite good. I see just as Lazarus Ezekiel, sell side liquidity. Definitely, we're going to mark out sell side liquidity. Okay, that's the first thing that we want to do because we want the sell side to be taken, tap into our demand, then we push higher. Number three, what are we going to wait for? We're going to wait for LQD sweep. Simple as that, right? Number four, what we're going to do is you can be able to confirm, wait for confirmations. Okay, now after liquidity has been swept, wait for the market to tap. Okay, tap into your demand level. Okay, once the market taps into your demand, number 5, wait for clear bullish confirmations. Right? Once you're done with that and you have waited for the bullish confirmations, quite clear. Okay, now once you have gotten the bullish confirmations, you can decide to do 2 things. One, you can enter using an aggressive entry or probably a conservative entry, sorry, or you can also wait for a market structure shift or a change of character, okay, on lower time frame, especially now M1, M3, or even M5, okay, and wait for the market to tap into your probably fair value gap or order block. If for me, I usually love tapping into my order blocks. Once the market taps into my order block, you can always come to the M1 or M3 or M5. Okay, once the market now, this is what I'm talking about. The market has tapped into your level of interest. Okay, this is your demand. Probably the market was just a minute. The market had created that sell side liquidity and the market had pushed up. So we waited for the market to take out these lows. Okay, tap into our demand. Now from here, you can wait for bullish confirmations. Now this is our now you can wait for bullish confirmations or you can wait for market structure shift. Come a little bit lower. The market has to always come back. Okay. And then what we can wait for is after you get in and you're in the buys, now you can target what? All right. Now target what you call buy side. Now liquidity. So you can be able to target buy side liquidity. Now buy side liquidity, as I said, those are external highs. Okay. Previous session highs, previous session highs. Okay, all those things you can be able to wait for them from that area. So this is our demand. Markets takes out sell side liquidity. So this is the demand. Market takes out sell side liquidity from this level. All right, so this was our sell side liquidity that is actually here. This looks more like equal lows just before, so it can also be more like inducement. I'm so sure you guys are going to ask me how about it can also be inducement. So we can have this as our sell side liquidity. All right, there we go. We have our sell side liquidity. Then this is going to be our buy side liquidity or our target or our drawn liquidity. We're going to talk about all those. Or sell side liquidity. Okay, I mean this is going to be buy side liquidity. So sell side, buy side, offering buying opportunities. Exactly. Okay, get in from this level after good clear confirmations and then have your target there. Stop loss has to be below our demand level, and we're always going to probably have a good 1 to 2, 1 to 3, or even 1 to 4 R. Okay, so this is for a bullish market. For the bearish market is the opposite. Identify hard time frame bias. Be a bearish. Mark now. Now this is you're going to be able to mark your buy side liquidity. Wait for a clear liquidity sweep. Wait for the market now to tap into your supply. Wait for clear bearish confirmations. Wait for market structure shift or change of character on lower time frame. Then target buy side. I mean now sell side liquidity. Now that's from the bearish market. Okay, so the opposite is true. Okay, higher time frame bias. Let me just now delete this or even have it the same. So we can have this. The market probably it was buying and creates probably equal highs. Okay, and the market decides to sell and probably our supply was above this area. Okay, so this can also be the same as the Asian range strategy. We use more of advanced concepts on liquidity to be able to understand them. So the market is going to come, take out this particular sell side. This is buy side now. The market is going to come, take out this buy side liquidity. Buy side liquidity. Once the market takes out the buy side liquidity, the market tapped into our supply, higher time frame key supply region. Then from here, the market we can wait now for clear bearish confirmations. Once we find bearish confirmations, what we can be able to target is this low, the first low that the market had created, and this low can be probably an session low, and this is going to be now our sell side liquidity. That's going to be our target. If you do this definitely you're going to make some good amount of money from the market. So this is our entry and our take profit. Simple, clear structure. Simple as that. Please confirm if you're understanding whatever I'm saying and everything is clear on your end. Quite good. Amazing. Liquidity, and supply and demand. Once you combine these two, you are good to go. Now, let's come and talk about liquidity grab and liquidity sweep, because it's very important for us to discuss that as we continue. Now, and also concepts on liquidity grabs. Okay. Now, what is a liquidity sweep? LQD sweep. Okay. Liquidity sweep. Liquidity sweep. So, what is liquidity sweep and how can we be able to use it to our advantage? Now, a liquidity sweep usually occurs when price briefly moves beyond a key high or a key low to trigger stop losses and pending orders before reversing. Okay, so this is a brief move. Okay, this is what usually termed as a brief move. A brief move beyond a key high or low. Right, just a brief move. Okay, to trigger what? To trigger stop losses and pending orders before reversing. So it's the same key concept that we have been talking about. Okay, it's just like when we're having a key demand area, and this is what actually happens most of the time. So the market was selling, okay, comes, takes out our sell side liquidity like that. Okay, the market starts moving. The market can ideally sweep this low, okay, also, and then from there can decide to push higher. All right, and especially once we have marked, probably, let me just have this now once again. So the market pushed higher from this level. All right, so you have marked out this key area of interest. Once you mark out this key level of interest, most of the time you're going to find that the market can create can start now coming down, create more like sell side liquidity, now start pushing lower, come to this level of interest, push higher, then one brief move to take out this low, to sweep it out. Then from here the markets now can change character, and this is where we can be able to get our buys from. So this also usually happens. So when the market does this, understand that the market was interested in taking out a lot of pending orders. So we had a lot of stop losses from this level. Liquidity was just within this range. So that's why it's important for you to understand that once liquidity has been consumed, so we had a lot of liquidity pending around this level, and this brief move is just to take out a lot of stop losses, all right, and also to trigger pending orders before now the market can buy from there. So that's usually what we call liquidity sweep, and we usually term it as being liquidated in the markets. So sometimes whenever we become liquidity in the market, our stop losses are usually triggered, and then the market can ideally move according to our direction. Just like the setup that we had on Friday. We were swept from a key level. I guess it was around 4100, but the market came to 4075. Then from there the market decided to push quite well. So you remember that setup that we had from last week on Friday. The market moved quite well from 4100, but we had a brief move to 4075, and from there the market decided to push higher. I will show you an example from there. So that's what usually called a liquidity sweep. All right, and for a bullish example, price will always sweep sell side liquidity, tap or take out stop losses. Then we have a market structure shift, and then price is going to rally above. For a bearish example, price is going to sweep buy side liquidity. Buy stops are going to be triggered. We have a market structure shift, then the price is going to sell off. Okay, so that's what we usually call a liquidity sweep. I hope you guys have taken note. It's just a brief move. Okay, that's quite important to note. So that's what we usually call a liquidity sweep, just a brief move. Then we need to discuss also more on liquidity grab and also false breakouts, okay, which is very, very important. Then we're going to end our session there. So we have liquidity grab, all right, stroke false breakouts, all right. Or we can also talk about liquidity grab versus genuine breakouts. Genuine breakouts, which is very important, okay, to note. So what is a liquidity grab? A liquidity grab is a quick move beyond a level. Price reverses almost immediately and designed to trap early buyers or early sellers. Okay, so this is just so liquidity grab looks more like a liquidity sweep, by the way. So what is a liquidity grab? Liquidity grab is a quick move. It's a quick move beyond a key level. Beyond a key level. It's very important to understand that. So probably we had this is our level of demand. So I want you guys to understand this concept. So this is probably where the market decided to have a good push from, all right? Then the market has decided to come back to this level, okay? Creates more like inducement, and this is where we want to buy. So the market can ideally take this market out first, okay? Now this is what usually grab. So sweep is just a brief move, but grab, the market will come a little bit lower. Okay, so whenever the market does this, then we can have a market structure shift, and from here the market will take your stop loss and then move in accordance to your direction. So probably whenever you see what you call a liquidity grab, is you didn't mark out your level of demand quite well. So if you check on the left side, you're going to find that this was the key area where the market was supposed to react from. Okay, if you look at the left side on the market, you just marked this market quite early, or probably from the 50% of that area. So this is what we usually call a liquidity grab. The market grabs this area quite aggressively. Okay, quick move, very sharp move, and this usually happens mostly on gold. And that's why we have our psychological levels. And this liquidity grab is just designed to trap traders. Okay. Then a genuine breakout is whenever we are having this kind of a situation or an area. All right. The market doesn't do this. Let me see. Okay, I didn't draw it. Okay, so let's have the same concept. The market pushes higher from this level and pushes higher. Market is bullish, so we want to get our buys from this demand area. So this is sell side liquidity, more of sell side liquidity, and we can have more sell side liquidity in one structure. The market comes, okay, and we want to buy. No clean confirmations. What the market does, it breaks it out, even confirms this breakout, and market decides to break out from that level. So this is what we usually term as a genuine breakout. Now this is not a false breakout. So liquidity grab, the market takes out this area, then moves in the opposing direction. So liquidity grab looks mostly like a reversal. Okay, it looks like a reversal entry, and then for liquidity or a complete breakout, or what we usually term as, let me just have it as a liquidity run, LQD run. So this is also quite important. Or LQD run, this is what we usually have. Okay, so we have a liquidity grab, then we have a liquidity run. A liquidity run is also a genuine breakout. LQD run is where the market doesn't respect your key level of interest. Okay, we have a strong momentum. Okay, the area is also going to be retested, and this mostly forms what we usually call continuational moves. Continuation. Okay, so that's quite important to understand. So there's a difference between liquidity grab and also liquidity run. All right, liquidity grab, markets grabs. It's a strong momentum to the downside for a bullish market. Market takes out your key level of interest and then reverses back. But a liquidity run or genuine breakout is where the market breaks out from this level. No clean confirmations. The market goes all the way lower. Okay, so you need to understand these key concepts. And probably someone can ask me, when are we supposed to know that this is going to be a liquidity grab or a genuine breakout? We don't know. And that's why we usually say we have to be speculators. We're just speculators of the market. That's why it's very important to wait for what? Key confirmations, either bullish or even bearish confirmations. Once you wait out for those confirmations, then it's going to be ideal for you to be able to either get into the buys, all right, for reversals, or sells for continuation. So that's very important. Some other key concepts that you need to understand is now, I hope you guys have understood this liquidity grab and also liquidity run. Before now, we talk about common trading mistakes people usually do. So one thing, number one, you guys need to understand is very simple. Now, common mistakes people do, common mistakes. And now after understanding liquidity and also combining liquidity with supply and demand, okay? Common mistakes people do, number one, is trading before LQD is taken. LQD is liquidity, okay? So always and always wait for liquidity to be taken before you enter. So don't enter early, and also don't enter too late. Very important, okay? Another common mistake people do is assume every breakout will continue. Okay, assuming every breakout will continue, and you don't understand the concept of liquidity grab. So not every breakout is a genuine breakout. We have a difference between liquidity grab and liquidity run. Okay, the other thing is also ignoring higher time frame liquidity or higher time frame bias. Okay, so it's quite important. Not even higher time frame bias. You can be good at higher time frame bias, but also understanding higher time frame liquidity. Where are the liquidity areas where we need to be able to enter, exit? Okay, very important. And also number 4, chasing price. This is a common mistake, even for mentors who are even here. Chasing price. And that's why I usually tell people never chase price like a mad dog. Chasing price after a liquidity sweep. Okay, so the market, and this is a common factor, the market has swept liquidity quite well, probably had some equal lows. Swept liquidity, now you're busy chasing the market and you want to get in probably at this level where the market is high, around this level. So wait for a clear reversal. The market will always come back to an imbalance, a fair value gap, or even an order block, and the market will continue pushing higher. So chasing price after a liquidity sweep, I usually tell people don't chase price like a mad dog. Okay, if the price has left you, please wait. Okay, and that's why it's important not to chase the prices. Always wait for the market to give you clear structures. Okay, get in after a pullback, which is very important. Okay, so some clear checklist also as we're winding up with this session. Some clear checklists. Okay, liquidity checklist, which is very important. The first one is ask yourself before entering a trade, where is the nearest liquidity? That's the first question. Number 2, okay, has liquidity been swept before you enter a trade? Number 3, is there a clear confirmation? Okay, bullish or bearish confirmation. Number 4, is there a clear demand or supply? Okay, S&D. Okay, or we can talk about, remember I talked about S&D as being OB plus what? OB plus FVG, an imbalance, which is quite important. So when I say S&D is order block and a fair value gap, we already talked about this. And also, does the setup align with a higher time frame bias? Okay, the last thing is number 6. Is the setup having a good risk to reward ratio? Simple, clean checklist for liquidity. Once you do this, you're good. A clear R risk to reward, at least it has to be more than 1 to 2, 1 to 3, 1 to 4, 1 to 5, even 1 to 6. Sometimes I can even be able to do 1 to 10, but not always. I usually do mostly 1 to 3, 1 to 5. Okay, so some liquidity takeaways as you're winding up. If you don't have any questions, so liquidity is what actually fuels the market. Okay, liquidity acts as fuel for the market. Price move from one liquidity pool to the next. Very important. Smart money hunts liquidity before making the real move. All right, and never chase breakouts. Wait for liquidity sweep for confirmations. So those are some clear takeaways. Liquidity is what fuels the price or the markets, acts as fuel. Okay, that's actually liquidity is actually what drives the markets. All right, so the up and down movement, that's what we usually term as liquidity. Price moves from one pool to the next, and smart money will always hunt liquidity before making the real move. Okay, it's just like a fake out, and never also chase breakout. So a very good liquidity formula that I can actually give you so that you guys can be able to understand all these concepts. Okay, liquidity formulae. Okay, understand where liquidity is resting. Once you have liquidity, understand market structure. Market structure is also the same as bias, or probably the are we bullish or bearish? Okay. After you understand market structure, mark your S&D levels. These are supply and demand levels. Once you mark them out, wait for time and price theory. Time and price to align. Wait for time to and price to align. Once you have this, you have yourself a high probability trade setup. Okay, high probability trade setup. Once you have this, you are good to go. Okay, and then next, the final thing that I want to talk about, which is the last thing, is or a final quote that I can be able to leave you, because this is just the beginning of liquidity. Next, we're going to be doing advanced liquidity concepts next week on Monday. So understand this. So this is going to be my final quote. Where retail traders see a breakout, smart money sees liquidity. Learn to follow the liquidity and you will begin to think like an institutional trader. Let me repeat that quote. Where retail traders see a breakout, smart money often sees it as liquidity. Learn to follow the liquidity and you'll begin to think like an institutional trader. There's nothing good as thinking like an institutional trader, like a smart money trader. Very important. Once you understand liquidity, you're good to go. Supply and demand, I'm so sure you guys don't have an issue with that. But liquidity, that's where we're having issues, and especially liquidity sweep. Okay, being swept, your B has been taken, etc. Sometimes we usually have issues where we ask ourselves, was it necessary for me to set my B, because your B is taken and the market moves according to your direction? We always have these issues. So it's important when we understand liquidity, we understand that it's important to wait for the market to sweep liquidity sometimes, especially when the market is at your area, key level of interest, and you're in the buy or in the sell, and the market has not decided to take off yet. So those are the areas where we're going to talk about what to do, and also what to be able to wait for the market to be able to give us some clean confirmations. Once clean confirmations are there, you're in the trade, then what are you supposed to do? You wait for your stop loss to be taken, or you set your B when the market moves according to your direction. So those are the things that you're going to be able to talk about when the market is at your POI. You're already in the trade and now you're waiting for the market to take off. So we're going to discuss more about them. So that's all about liquidity. I hope you guys have enjoyed that concept. Please give me those reactions if you have enjoyed that session. Quite good. Amazing. Thank you so much. Quite amazing.